Hello, let's make a brief analysis on Industrial Enterprises of America. Ticker symbol is IEAM. This is the chart since the IPO. It's quite an erratic chart. I don't know what happened here. And let's move on to the medium term. Okay, the stock has had this big spike up here, then this nasty sell off here, and now it has been trading sideways. So there's no technical definition on the IEAM. And over the short term, well, the stock seemed very attractive from a fundamental basis, but that's really hidden behind the numbers. And it started selling off because there wasn't any catalyst to move it sharply higher. And today an analyst on CNBC said the stock trades at 4 times earnings. I don't see that. I don't know how he sees 4 times earnings, but anyway, I've derived my valuation model for IEAM and we'll study next. Yesterday, on the prior day, there was an SEC filing, Form 4, saying that Pike Capital bought another 415,000 shares. And the stock went down. That could be a nice catalyst because it would prove that core investors are still buying and believing in the future of the company, seeing the opportunity. But no, that wasn't any catalyst. The stock went down on that day, and now that the guy on CNBC talks about it, the stock goes up. So not the best setup to make a catalyst for the stock to move sharply higher as it should. But probably it will drift lower again, I believe, after this gap up. Not the best reason to buy because some guy says buy it on the national TV. Anyway, my valuation model, here we have it. You know, these yellow lines are known facts, white lines are my estimates, and dark yellow lines are calculated by the model. Well, we have the share price now at $5.45. Initial share count 13 million shares. The company has been buying back shares, but it still has a lot of options outstanding, and they have also insiders have been buying. Well, I've put here a dilution factor of 1, which means no dilution expected going forward. Because I expect the share count to increase, but the company to keep buying back shares, and that to counterbalance each other, and the share count to remain stable. Initial revenue, this is the revenue the company had over the past 4 quarters. It was $50.6 million, and I expect this to grow 50% a year going forward, because of what the CEO said at the conference call and at investor presentations. I believe this is a reasonable number because if they do 2 shifts, the production will increase, and with 3 shifts even more, and on weekends and everything. So he clearly explained why revenues will grow a lot, but I believe perhaps it will be more this year, more than 50%, but wait and online I don't see more than this, so I put here a revenue CAGR of 50%. This means 1.5 here on my valuation model. This gives me a final revenue. This is for fiscal 2009 of 171 million. Initial net profit margin. Well, this was very hard to figure out because there are a lot of derivatives and derivative expenses. The company has been accounting that as interest payments, but I've taken that out and considered a 40% tax on income, and that gave me a 7.16% net profit margin. Also 200,000 of interest payments. The CEO said that would be what they would have after these charges are gone, and that will happen in Q3, at least according to the CEO's words. And I believe that net profit margin will continue at roughly 7%. Gross margin is about 25%, so It can't expand much more than this. At the optimal, it will be 10%, but I believe 7 is more appropriate. And this gives me a final net income of 12 million, which means 92 cents of earnings per share. Well, I'm just a bit afraid that the share count won't be 13 million, and that would decrease the 92 cents. So one has to be very attentive to the changes in the share count. With an 18 earnings per share multiple estimate, I get a final estimated share price of $16.56 for late 2009, early 2007, which means a share price compound annual growth rate of 44.8% and an optimal selling price of 10.61. This optimal selling price is the price where, given these estimates, the stock would start returning less than 16% per year. So 1061. So I see it as attractive, but maybe not as attractive as other fellows see it, but still very undervalued and very attractive. On a 1 to 10 scale, I give it an 8. Thank you. Bye.